This is Horizons Middle East and Africa. Our top stories here this morning. Real impact. Brazil's currency plunges after U.S. President Donald Trump threatens a 50% tariff on the country, calling on authorities to drop charges against the nation's right-wing populist former president, Jair Bolsonaro. OPEC officials double down. Saudi Arabia, the UAE, and Kuwait say additional supply was needed by the global market. We are live in Vienna with the latest. And President Trump says the United States is shifting from aid to trade as he welcomed 5 African leaders to the White House for a summit. It's just gone 8 a.m. across the Emirates, midday here in Hong Kong. I'm Yvonne Manin for Jumana Bershetschi. Take a look when it comes to markets here this morning. It's a little bit wobbly when it comes to how U.S. futures have been throughout this Asia session as well. Obviously, what we saw in the last couple of hours is these new tariff threats with Trump saying 50% tariffs on copper imports to take effect in August 1st. That certainly has led to a little bit of weakness in the dollar in the last few hours as well. And risk assets a little bit on offer here in Asia. Bitcoin, though, briefly touching 112,000. That certainly was a highlight during that U.S. session. And Nvidia as well. You talk about this now being a $4 trillion company with market cap, the first company to ever reach that milestone. You certainly saw in the U.S. markets, there's still quite a lot of bullishness in the AI trade, and traders overall are shrugging off some of these trade headlines. But where you're seeing a lot of that angst potentially is, of course, still the commodity markets there. You talk about how copper futures, COMEX futures in the U.S., there are perking up just slightly there on the back of that announcement as well from President Trump. So we're up about 2.5%. And that spread seems to be narrowing a little bit against with LME contracts here this morning. But yes, we're also counting down to this OPEC Plus meeting in Vienna as well. Our very own Jumana is on the ground there here today. We're flat when it comes to Brent, holding around $70 so far. And let's check in on how markets in Asia are faring. Our very own Avril Hong is live in Singapore. Avril.
Yeah, Yvonne, I mean, we're seeing a mixed bag when it comes to Asia stocks, right? With Japan underperforming as the yen firms up, but the rest of the region looking quite bright, particularly when it comes to tech stocks following on from Nvidia. And we're seeing how the likes of South Korea, they're outperforming. And this is helped along by the BOK leaving rates unchanged as expected. It is also assessing further the tariff impact on the economy. But you also get the sense that overall, traders don't seem terribly disturbed by these new round of tariff letters. They seem to be focused more on the prospects for the economic growth as well as corporate profits, separately keeping an eye on the long-end debt in Japan. We had an auction for 20 years and that showed pretty solid metrics overall, but that's not to say that there aren't still these concerns about fiscal spending, particularly playing out on long-end debt that have been overall seen yields rising, not just in Japan, but globally as well. Yvonne.
All right, Avril, thank you. Avril Hong joining us out of Singapore with the latest. Let's get to our top story now. President Trump says the U.S. will slap a 50% tariff on copper imports from August 1st. He's also unveiled a new round of tariff demand letters, including a 50% rate on Brazil. For more, let's bring in our Bloomberg editor, John Herskovitz, joining us with the latest there. John, what was unusual, you think, about these tariffs for Brazil?
First of all, just the level of the tariff, 50% is one of the highest that the Trump administration has imposed. And also, this tariff is linked to an internal judicial process with the former president, Bolsonaro, who's facing a serious prosecution. It's almost unprecedented. In fact, we had one analyst say that it is unprecedented for the U.S. to use tariffs as a way of trying to tip the scales in another country's judicial proceedings. And Brazil, for itself, has run a deficit with the U.S. in terms of trade for years. So if the ultimate goal is to reduce the U.S. trade deficit with other nations, Brazil is one nation where the U.S. has a surplus. So there are a lot of things that are unusual about this, and it may also boost Brazil's President Lula, who's been facing some difficult times in the polls. He's said he's going to fight back. There'll be some countermeasures coming from his country. So there's a lot going on with this Brazil tariff, which was rather unexpected and really just is not something of the likes that we've seen previously.
The surprise yesterday was on copper tariffs. How do you think those fit into other sectoral tariffs from the Trump administration, John?
Yeah, with the sectoral tariffs, we've seen a lot of protection for the metals. We've seen it for aluminum, which has had a tariff imposed, also for steel. So copper is the latest, and it's 50%, which is a really high level. The idea is to boost the domestic industry for these metals in the U.S. But the thing is, these are key metals for production. It's going to add to input costs for makers. This will put on inflationary pressures onto the economy. Also, these sectoral tariffs make it difficult for the nations that are trying to do bilateral deals with the U.S. On one hand, they're doing what they're to protect their economy, and a lot of countries are getting hit by these sectoral tariffs. So it's part of this overall idea of protecting the metals industry, but also it's going to be rather difficult for the U.S. to suddenly grow its ability to produce copper from August 1st when these tariffs take effect.
John, thank you. John Herskovitz there joining us out of Tokyo. And for more on what this means for markets and what's in store for the second half, Charles-Henri Monchau, CIO at Banque Syz, joins us now. Charles-Henri, it's great to have you on the program. You take a look at the first half, and the report card was quite good when it comes to risk assets, right? You know, U.S. stocks are back near records. You have Bitcoin 112,000 here right now. But then again, there's still a lot of volatility in bond markets overall. How should I look at the second half moving forward?
Yeah, so indeed, yesterday was the famous 9th of July deadline, and we got these all-time highs for the DAX, for the NASDAQ, for Bitcoin, as you rightly mentioned. So as we enter the second half of the year, I think for the time being, the market is very much focused on this story of lower taxes, lower tariffs, and lower rates ahead. This is a kind of Goldilocks framework for the markets, with sentiment which is starting to get a bit too complacent, and also valuations which are stretched, because if you look at US large cap, for instance, they are back to very high multiples. So on our side, we think that the second half is going to stay volatile. We think that when it comes, for instance, for rates, that probably will get less rates than the market currently expect. We think maybe one rate cut will be, let's say, down for the Fed. And also, I think there is something that the market needs to focus on, is that first, on the tariff side, the aggregate level of tariff is going to be higher than the current level, so lower than 2nd of April, but higher than the current one. And two, Mr. Trump was lucky in the first half because he got the tariff story at the time when liquidity was ample. Remember, there was the debt ceiling. Now the debt ceiling is lifted, which means that the TGA, the Treasury General Account, needs to be replenished, which means that liquidity will be reduced. So tariff stories at the time where liquidity is draining is going to be a bit more challenging for markets.
And you mentioned liquidity. Obviously, what we're seeing in the long rates is certainly where we're seeing a lot of ructions globally, whether it's Japan, whether it's in the Treasury market. And it seems like it's really now ultra-long bonds that are driving a lot of the price action compared to what we're seeing monetary policy and short-rated debt. Is this a sort of a new regime that we're seeing in the bond market now, Charles-Henri?
Yvonne, you are spot on. I think that's the drive. At the end of the day, in the first half of the year, the bond market was the ultimate ruler of what happens. Mr. Trump had to change his mind, had to pedal back, because the bond market was telling him that he was going too far. And the same could happen in the second half of the year. I was quite, let's say, surprised that the market didn't pay more attention to what is currently taking place in Japan, with the long end of the curve, with the 20-year, 40 years yield, keep moving higher. I think that what happened this morning with this auction, which went well, is probably good news in the short run for the market. But we know that, the higher these Japanese bond yields go, the higher the risk of another a carry trade unwinding, which could take place. The last one was quite painful during summertime, remember 2024. So it can happen also this year.
And those rate differentials are really being divorced from what we're seeing in the U.S. dollar, which continues to see this sort of downtrend. What should I be doing in terms of FX hedges now for portfolios?
Yeah, we think that the let's say the setup for the dollar is still on the negative side. So will it be fundamental, and also the willingness of the Trump administration to push the dollar down remains, let's say, key drivers. That being said, alongside our thesis that rate cuts will not happen as much as the market expect, because the economy is probably doing better than the market expected, and because also tariffs are inflationary. So the Fed is not going to cut too much, and that could put a floor on the dollar. So we still see some weakness on the dollar, but we think that the decline will be much less pronounced than what we have seen in the first half of the year.
What should I be doing with duration?
Yeah, duration is, we prefer to be in the belly when it comes to the US Treasuries curve. We think that the long end of the curve remains too dangerous, especially if, for instance, the Fed start to use the tactic of a shadow chair. If they try to influence the market by saying that a lot of cuts will happen in 2026, then the long end of the curve might pick up, and that's quite dangerous. So this is why we prefer to be on the belly, where we see the most value in terms of US Treasury yield curve.
I got to get your take on what the euro's doing. It's been an absolute tear against the dollar. We're approaching 117, 118 levels here right now. At what point does this get a bit too strong for the equity market, which still seems to be quite red hot these days?
I fully agree. I think we're already there, despite the fact that the DAX made a new all-time high. Look at the CAC 40 in France, which is very multinational exposed. The strength of the euro is starting to put, let's say, some pressure on earnings growth expectations. Earnings revision in Europe has been not as good as in the US, for instance. And this is why, by the way, the last 2 months, US stocks have been outperforming European stocks. So I think we get into territory where the strength of the euro is going to penalize euro equities.
Charles-Henri, we got to leave it there. Charles-Henri Monchau, their CIO at Banque Syz, joining us out of Geneva this morning. Thank you. Well, coming up, tariffs in focus as Malaysia's Prime Minister meets the U.S. Secretary of State today in Kuala Lumpur. We're going to cross live to the ASEAN meeting next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Yvonne Mann in Hong Kong. Well, Malaysia's Prime Minister Anwar Ibrahim will make an appeal for lower tariffs when he meets with U.S. Secretary of State Marco Rubio today at the ASEAN meeting. Let's bring in our correspondent, Min Lo. She joins us live for a second day there in Kuala Lumpur. And Min, Wang Yi already met with some ASEAN foreign ministers this morning. How did that meeting go?
Yes, Wang Yi met with the ASEAN foreign ministers, and the Malaysian foreign minister gave his opening remarks, making a nod to the security situation in the South China Sea and urging all parties to work towards coming up with a code of conduct, which is in fact something that all the countries have been trying to make progress towards for many years, but progress has been extremely slow. He also talked about the threats to free trade, and Malaysia, or rather ASEAN and China, will be working towards signing an upgraded free trade agreement before the end of the year. There you can see on the screen Wang Yi actually refusing to speak to the media. We were trying to ask him some questions, but you can also see him. He paused for a few beats, holding on to the hand of the Malaysian foreign minister as he exited the room. And it really shows, it's a very symbolic gesture to show how China remains in very close ties with the ASEAN countries, that they continue to deepen cooperation even amid this global rise in protectionism in many countries.
In terms of other meetings coming up, we're hearing that Marco Rubio is there. He's going to be meeting with Sergei Lavrov later on. How significant is that? And will he have a chance to really meet with Wang Yi on the sidelines?
Yes, so the meeting with Sergei Lavrov is being closely watched because it comes as Russia has been pounding Kyiv and many Ukrainian cities with a record number of drones and missiles. And President Trump had previously said he was looking seriously into this new bill that is being introduced by the Senate that would sanction Russia along with other countries that buy Russian oil, LNG, petroleum products. And of course, China is a major buyer. So if that bill goes through, it will have significant implications on U.S.-China relations as well. It's not just Sergei Lavrov. Marco Rubio is also meeting with the Malaysian Prime Minister, Philippines as well. They are saying they want to continue trade negotiations with the U.S. after the U.S. raised the Philippines tariffs up to 20%. And of course, that meeting with Wang Yi, that's the one that Wang Yi did not answer our question when we asked if he'll be meeting with Marco Rubio. The Chinese Foreign Ministry as well said they have no information to offer, but still notice that it wasn't an outright denial. We still have a couple of days here. It is possible that these things could be squeezed in at the last minute, so we'll be keeping an eye out for whether or not the two men do meet. It will give us a sense of the temperature of relations between U.S. and China.
Yep. Okay. A lot happening on the ground there. Correspondent Min Lo joining us there from KL. Thank you so much for the time. And so, taking a look at some other stories that we're tracking for you today. President Trump says negotiators are very close to a ceasefire deal between Israel and Hamas. But a senior Israeli official is less optimistic, repeating the long-standing position that for a permanent ceasefire, Hamas must lay down its weapons, which the group has so far refused to do. Hamas said on Telegram that it has agreed to release 10 Israeli hostages. Indirect talks in Doha are still discussing flows of aid into Gaza, Israel's withdrawal from the Strip, and guarantees for a permanent ceasefire. The U.S. has imposed sanctions on Francesca Albanese, a United Nations expert investigating human rights conditions in the Palestinian territories. Secretary of State Marco Rubio says it's in response to a, quote, campaign of political and economic warfare against the United States and Israel. Last month, Albanese's office issued a report calling out U.S. companies for their involvement in Israel's economy amid allegations of war crimes and genocide. And coming up, Kuwait State Energy Company CEO sees demand growth continuing after OPEC Plus's decision to further hike output next month. More from our interview next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Yvonne Mann in Hong Kong. Well, Kuwait State Energy Company says the latest OPEC Plus supply hike and recent interactions with customers suggest persistent demand growth beyond the summer driving season. Nawaf Al-Sabah spoke to us at the cartel seminar in Vienna, saying producers are seeing an oil market that will continue to grow.
Thankfully, I don't do OPEC policy, but we implement the reaction into the market. So we're really seeing a market that will continue to grow. We're seeing it probably from anywhere between 1 million to 1.3 million of additional demand growth over the year, with the supply growth perhaps matching that, but not necessarily. So we're really seeing some potential tightness in the market. And it's giving us an opportunity to capture market share into the future.
Interesting. Yeah. So building up on some of those comments, we heard from energy CEOs just now on one of the panels. BP CEO was saying there's healthy demand in oil. They see growth of 1%. Shell CEO also talking about fundamentals being tight. You also talk about tightness in the market as of now. Do you think that it's going to look the same in a couple of months' time?
Certainly the summer driving season always gives a lot of tightness into the market. But if you notice that OPEC Plus's decision to increase production, acceleration of that unwinding, really starts hitting in August. And that's towards the end. By the time those barrels really hit refineries, it's the end of the summer driving season.
Yeah.
So it is actually an indication that this demand growth is persistent beyond just that summer season. So we're really seeing that stretch into the fall.
From your perspective, where is the biggest demand coming from? Is it mostly Asia?
It continues to be Asia.
Yeah.
But we're seeing actually a strong demand for refined products, even in Europe. KPC is one of the largest suppliers of jet fuel into Europe and diesel. So the middle distillates market is actually quite strong in Europe. Jet fuel growth has been strong across the sector, and the crude supply and crude demand growth in Asia remains strong.
How are you feeling about the geopolitical situation right now in the region? And I know so much of the geopolitical premium has come out of the price of oil, but still, a potential episode like this could flare up at some point again in the future. How do you see things?
Unfortunately, I've been around in this business long enough to have seen almost every single day in this region have some sort of a security premium or risk associated with it. If you go back to the 1980s, it was the Iran-Iraq War, then obviously the Iraqi invasion of Kuwait, followed by continued sanctions and whatnot. So it is always a region that faces security risk and a security premium. However, it's very important to note, for over 8 decades of oil flowing through the Strait of Hormuz, not a single day has that strait ever been closed physically to traffic. But it has been threatened. And that's where we work on our contingency plans with our partners around the world. And that's where we have now stored crude oil in other parts of the world to make that available to our customer base.
That was the Kuwait Petroleum CEO speaking to Bloomberg's Jumana Bersetsi in Vienna. Now for another look at some other stories that we're following for you today. The battle for top AI talent is heating up as Meta lures one of Apple's AI chiefs. Bloomberg understands that Meta has hired Roming Pang, who ran Apple's AI models team, with a salary package, get this, worth $200 million over a several-year period. The pay package is in line with other major hires from Meta's new superintelligence team, focused on building AI systems that can complete tasks as well as, or better than, humans. Amazon's annual Prime Day sale is underway, but initial numbers from the 4-day shopping event are indicating weak sales. Brand advisor Momentum Commerce reported a 41% drop in first-day sales compared to last year. Amazon is betting on the extended sale period to give shoppers more time to navigate the millions of deals on its site. Linda Yaccarino is stepping down as CEO of Elon Musk's social media platform X. The former NBC Universal executive was hired by Musk in 2023 after he fired or lost about 75% of employees at the company previously called Twitter. Yaccarino repeatedly defended her boss and the platform from critics who allege a rise in violent content, anti-Semitism, and misinformation since Musk's takeover. All right, we're taking a look at when it comes to equity futures in the U.S. and when it comes to what we're seeing, it's still seeing a bit of pressure here today. The Euro Stoxx 50 futures, though, a little bit better picture there and how things are going to wake up in Europe this morning. Potentially, we're seeing here a lot of talk about these trade deals, what we're seeing with copper imports and what's been slapped to 50% tariffs in effect in August 1st. That has sent some wobbles in the equity market here in the Asia session here as well. And of course, we're tracking treasuries and oil as well. The long end, as we focus on that JGB auction in Japan, pretty weak when it comes to what we saw in the 20-year yield. So we are seeing yields perk up a little bit there in the treasury market this morning. And we're focusing on oil. Coming up, Mideast oil giants double down on the supply hike by OPEC Plus. We are live in Vienna with the latest. This is Bloomberg. This is Horizons Middle East and Africa. Our top stories this morning. Real impact. Brazil's currency plunges after U.S. President Donald Trump threatens a 50% tariff on the country, calling on authorities to drop charges against the nation's right-wing populist former president, Jair Bolsonaro. OPEC officials double down. Saudi Arabia, the UAE, and Kuwait say additional supply was needed by the global market. We're live in Vienna with the latest. And President Trump says the United States is shifting from aid to trade as he welcomed 5 African leaders to the White House for a summit. It's just gone 8:30 a.m. across the Emirates, 12:30 p.m. here in Hong Kong. I'm Yvonne Man in for Jumana Bersetsi there. Take a look when it comes to markets here. You're seeing some trade jitters there, but I stress it's some on the equity market front here today. You take a look at how U.S. futures are going. We're slightly to the downside. The biggest news really has been President Trump confirming that those 50% copper tariffs are going to be in place in August 1st. So that sent some wobbles in the dollar as well. Bitcoin, we've shrugged off, or at least we're off some of the highs after it briefly touched 112,000 for the cryptocurrency And NVIDIA, that was the standout in the overnight session there. It's now a $4 trillion market cap company, or at least briefly during that U.S. session. So AI trade, is that still on in the second half? That certainly is a key question here as well. But where you're seeing that trade angst is going to be in the copper markets. You take a look at how COMEX futures are doing in the U.S., and we're up more than 2% here right now. You are seeing the LME contract also slightly to the upside, and we're still watching how crude markets go here as we count down to that OPEC Plus meeting in Vienna. We're seeing Brent just around that $70 level here this morning. Let's check in on how markets in Asia are faring. Avril Hong is live in Singapore. Avril.
Yeah, Yvonne, we've been tracking very closely the results of the Japanese 20-year bond auction. You might recall that a couple months back, very weak showing is what exposed the fragility not just in Japan, but global debt markets. So we've been tracking very closely the results of the auction. You're seeing one of the gauges of demand, bid to cover ratio, slightly above the prior month reading, a bit of an improvement, but it's still below the 12-month average. So it's solid metrics on the surface, but it also exposes some of these deeper concerns among investors about fiscal spending in Japan, especially ahead of an upper house election where the ruling coalition is sort of going into with a quite weak position, given how the government hasn't been able to ink a trade deal with the U.S. And that has also meant that they've been trying to entice voters with handouts. So again, the concern about fiscal spending in Japan that's weighing on long end debt. For now, you're seeing a bit of firmness in JGBs in the long end, and that's sort of tracking what we're seeing in U.S. Treasuries, but the concerns remain. Yvonne.
Avril, thank you. Avril Hong there joining us live from Singapore this morning. Well, senior officials from 3 of OPEC's core producer nations, we're talking Saudi Arabia, the UAE and Kuwait, say the global market needed the recent decision to further hike supply. Here's what some analysts have been saying about the increase at the cartel seminar in Vienna.
There's a lot of indicators that suggest that demand is better than expected, especially considering the tariffs and the concerns about global growth that they've raised over the last few months. Yeah. So, yeah, it has been, in hindsight, a good time to return the barrels to the market.
I think the concern is much more 2026. That this oversupply will begin to hit in 2026.
It chills, baby, chills at 50. I can tell you, my clients in Texas are none too happy about this call for $50 oil.
So there is a sweet spot. It's hard to say exactly where it is. I would say we're close to it at the current price, or at least in the 60s for Brent.
Let's go live now to Vienna and bring in our Horizons Middle East and Africa anchor, Jumana Basheti. Quite an interesting sort of commentary that you got from guests there in the last 24 hours or so. How are things looking today?
Yeah, well, I'm still laughing at the comment from Bob McNally about chill, baby, chill instead of drill, baby, drill. So that really is reflective of some of the mood coming from U.S. producers. But we are at the second day of the OPEC seminar. So much going on here. Lots of discussions yesterday about perhaps the more longer-term projects for energy. But then, of course, OPEC Plus and their decision-making very much in focus. Very happy to say that Daan Struyven, the global head of commodities research from Goldman Sachs, joins us right now. Really good to have you with us here.
Thank you for having me.
So you were inside the seminar yesterday, and I guess you had lots of conversations with people about the long-term dynamics, but then also short-term. Did you walk away with a better understanding of why OPEC Plus have accelerated the putback of all of these barrels to the market?
Yes, so this conference is very insightful because a quite unique concentration of policymakers, executives, analysts, journalists like yourself getting together and exchanging thoughts on this fascinating market. In my view, OPEC's voluntary production cuts were always meant to be temporary. OPEC always signaled that it had the flexibility to bring barrels back to the market when it would judge that there is room. And so far in the spring and the summer, the market reaction suggests that there has been room to bring barrels back to the market. More broadly, I would contextualize the decision to raise production in a broader context where OPEC is aiming to normalize market share, normalize spare capacity, and also to further improve cohesion with the group. And we have seen improvements in compliance with the production cuts as well.
Yeah. So do you think that they are set to unwind completely, fully unwind the voluntary cuts with the last clip in August that sort of brings all of that 2.2 million barrel per day voluntary cut to an end?
Yes, that's our expectation, that you get another 0.55 million barrels per day increase, at least in the quota for next month. And then you would have fully reversed the 2.2 million barrels per day.
Okay, but there's also another 1.66 million barrels per day of voluntary cuts. Do you think attention then shifts to that, or are they going to bide their time and wait and see what happens?
I think attention will shift to the next round. Our base case remains that they will be done raising production once the 2.2 million barrels per day sort of second post-pandemic round of cuts is unwound. But it will depend on the balance. It will depend on inventory levels, and we forecast a surplus for both this year and next, and that's why we think we will soon be done raising production. But it will ultimately depend on the data.
How big of a surplus do you see? Because that seems to be also the swing factor in terms of decision making. And I've seen so many different estimates about how demand is going to pan out by the end of this year. Some people have it at 500,000 barrels a day. You speak to the likes of Aramco, KPC, they're talking about 1.2, 1.3 million barrels a day. Where do you see it?
Yes, I think there is a lot of agreement here that Western oil markets are quite tight, with low inventory levels in the US, very low diesel inventory levels. That's why diesel margins have spiked. But there's a lot of debate about next year and about demand. We actually think that the market so far this year has been in a surplus. We have seen builds of around 1 million barrels per day. Mm-hmm. That's essentially also our forecast for the surplus for this year, and for next year we have 1.5 million barrels per day. What's really fascinating is that the builds have been concentrated outside of the Western pricing centers, with very low inventories, for instance, in the US, in Cushing, but increases in inventories on water, and also in Asia, for instance, in China. So the big question is, if we are right and that you're going to stay in a surplus where supply exceeds demand, are you going to see a more equally spread rise inventories? That's our base case, and that's why we look for moderate declines in oil prices. But if the inventory levels remain very low in the West, you could see a bullish scenario where prices stay around current levels, at firmer levels than our base case.
Do you see any upside surprises coming through on the demand side? Because again, if you look at the macro, taking a step back, I would say more recently you're getting better activity indicators coming through from the US and perhaps other signs of the world as well, other parts of the world.
Yeah, so our base case has demand growing this year by 600 KBD. We have flagged some upside risk to that estimate. We're seeing some beats in China, where our nowcast for demand is up 400 KBD on a year-over-year basis. European demand also seems to be coming in a little bit stronger. And then in the Middle East, with a very hot summer, AC demand is also very strong. So moderate upside risk to demand. That said, I find it hard to imagine demand growing by more than, say, 1.2, 1.3 million barrels per day in an environment where China demand is just structurally, not growing at the very spectacular pace it used to do before the pandemic.
Yeah. Let me ask you about the geopolitical premium that was briefly priced into the oil curve around the 12-day war. Have people just forgotten about that now? I mean, do you get a sense that perhaps people may want to still hedge for the possibility of things flaring up again, or has the episode just come and gone and the market has moved on?
Yeah, the geopolitical risk premium has come down pretty quickly. We think it's worth currently maybe $3 or $4. I don't think it's completely off people's radar screen. We had some attacks by the Houthis in the Red Sea. We had some headlines about Iran's nuclear program last week. So I think it's still top of mind, but of course much less so than a few weeks ago. And I think the reason why this risk premium has evaporated so quickly is that we have seen several major geopolitical shocks in the last 2 years with actually no meaningful supply disruption.
Yeah, physical impact. Look, while I have you with us, I really do want to ask you also about the copper tariffs that the Trump administration has announced this week, obviously being a big driver for market action, specifically in copper as well. Yeah. How do you see things panning out from here onwards, and what is the outlook for copper markets that you follow?
Yeah, so President Trump has announced a 50% tariff on U.S. copper imports effective from August. We have been recommending to our clients to go long U.S. copper prices versus international copper prices. If you look at that price differential, it's now pricing in a roughly 30% tariff. Our base case is 50%. We really do think that the Trump administration is very focused on boosting supply of copper, which is a very important critical mineral also for the defense industry, the second most widely used metal by the Defense Department. And so we think that pricing, that 30% tariff pricing, has room to increase further.
What if there's an exemption, say, to Chile or one of the other large trade partners of the U.S.?
That's a great question, and that's why we think sort of the market perhaps should be pricing a 40% tariff or so, because there is some room for exemptions.
Yeah.
At the same time, the steel and alloy tariffs are also at 50%. And copper is a very critical mineral. And more broadly, I think the US wants to become dominant in most commodities. It's already energy dominant, but very reliant on the rest of the world. For metals, metals are becoming more and more critical for the economy, for the defense sector, for the industrial sector. And so we really do think that President Trump is very focused on boosting production of copper in the US.
Daan, a pleasure to chat to you. Thank you so much for joining us. That's Daan Struyven, Global Head of Commodities Research at Goldman Sachs. And we're here for the second day of the OPEC seminar here in Vienna. Yvonne.
Great stuff, Jemana. Thanks so much, and we'll come to you soon. An update on what's going on there in Vienna. And coming up, a closer look at how Trump's tariff threats may impact emerging markets. We have 91's co-head of EM corporate debt joining us next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Yvonne Men in Hong Kong. More now on President Trump's latest round of tariff demand letters, including threats of a 50% rate on Brazil. And he's also set to hit Algeria, Libya, Iraq, and Sri Lanka with 30% levies and 20% when it comes to the Philippines. What does this mean for the EM space? Joining us now is Victoria Harling, co-head of EM corporate debt at 91. Victoria, it's great to have you. Despite all these trade uncertainties and really what this means for the eco outlook for the world, you're still seeing credit spreads that are basically pretty tight around the world. How long do you think that can last? And can those spreads actually get even tighter?
Yeah, I think absolutely the underlying level of interest rates is very appealing for credit investors. And what we have seen since Liberation Day was a reinforcement of the fact that the markets are primed for investors to move more into corporate debt world, given the strength of corporate balance sheets generally in the world.
And a lot of it is how you frame the whole U.S. dollar view. Given that, there's still so much talk about de-dollarization, or whether it's just some sort of cyclical sort of downturn in the dollar, what sort of framework are you looking at here right now when you look at maybe hard currency and local currency debt?
Yeah, I think what's important to focus on is the fiscal strength of emerging markets, certainly for corporates looking at their financial resilience. And it's really clear that EMs are actually pretty well run in the context of global government balance sheets and corporate balance sheets as well. So from a resilience perspective, EMs are extremely well placed to sort of weather this global environment.
And you've been talking about this traditional labels are outdated, this EMification of DM. When people are starting to doubt, how risk-free U.S. Treasuries are, for example, how real is that sort of trend you see now?
It's meaningful. I mean, actually, one of the most interesting sort of developments that we've seen post the announcements of tariffs and this constant sort of push against the world doing business with each other is the fact that EMs are looking for new homes other than the US, which has been the prime destination of asset allocation for the last few years. So we've seen a lot of issuance actually out of European credit, and it's been placed very, very well. We've seen some Middle Eastern issuers actually issuing in Aussie dollars, and we continue to see a push from Asia to diversify its credit book into emerging market borrowers, particularly investment grade. So we've seen that across Asia and here in the region in the Middle East.
Yeah, I'll ask you about where to in the whole risk spectrum. You're saying investment grade, is that sort of the sweet spot that we continue to be in right now for credit?
It's 100% the safest spot to be in, and yields are attractive. So if you can hit anything from 5.5% to 6% for investment grade credit, that's absolutely giving you the best resilience that you can have on balance sheets and understanding that ability to repay remains high, whilst also satisfying for a reasonable return. And I think that's what we have seen investors really focus on. Investment grade has been the sweet spot this year for sure.
Can you tell us a bit more about some of the micro stories that you're tracking? You mentioned the Middle East, maybe here in Asia as well, in terms of where are some of the pockets where you could still get pretty good yield right now?
We've actually seen quite a lot of issuance out of Saudi Arabian banks in subordinated debt. And again, the yields that you're getting paid there are extremely attractive for a banking sector that remains robust. So we've seen huge demand in the last few weeks for that sort of paper. Again, you know, investment grade credits, when they're coming to the market, there's just an excess of demand because actually investors have a lot of cash on their balance sheets and are just looking for very strong stories to invest in. But we see that particularly in investment grade space, moving down the capital structure where you can for very high quality issuers, that affordability and ability to repay is very strong.
Can you tell us a bit more about how you're tracking the second half? I mean, there's a lot of macro headwinds, whether it's tariffs, whether it's fiscal deficit concerns and the like here. Would any of those sort of headwinds that you're seeing impact your view overall on EM debt?
Yeah, look, I mean, the reality of the situation is it's far too early for us to have any conclusions around the impacts of tariffs and the magnitude that's actually going to come into effect. For sure, we're going to see some negotiations take place. And really, the big impacts will actually be felt more around US interest rate policy, inflation dynamics, and growth, and that net impact on a global slowdown. The actual announcements that we've seen, particularly in Brazil overnight, have been reasonably limited on the Brazilian economy, given the small export base to the US. But it will have a global impact on general slowing overall. And we have to see how that plays out. But by and large, because central banks have been preemptive, we have high interest rates, we have some cushion for lower interest rates going forward that should help EMs weather the storm better.
Victoria, thanks so much for joining us. Victoria Harling there, co-head of emerging market corporate debt at 91. And coming up, President Trump says the U.S. is shifting from aid to trade as he welcomes African leaders to the White House. We have details of the Africa Summit next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Yvonne Mann in Hong Kong. President Trump has welcomed leaders of 5 African nations to the White House, hailing the continent's economic potential. Trump says the U.S. is shifting from aid to trade, suggesting the assembled countries could be exempt from planned reciprocal tariffs. For more, let's bring in Bloomberg's Andiro Ganga joining us now. Andiro, it seems like it was a quite positive meeting between the African nations and the president. What are some of the key highlights?
Well, I don't know if it was positive or it was just a neutral meeting, but just listening to the African leaders speak, it felt like they had all been well briefed and well prepped by the team, leader after leader. You could get a sense that they were kind of reading from the same script. First, it was President Donald Trump, then second, picture challenges as an investment opportunity to the U.S., and then finish by praising Trump again and reinforcing the fact that America is a very important ally to the region and the African continent. And with the big boys missing on the table, Nigeria and South Africa, one couldn't help but wonder why these 5 countries, they have a combined GDP of only $75 billion. But when you look keenly, you realize that these are coastal countries that sit on the coast of the Atlantic Ocean, and they also have access to critical and rare earth minerals that are very necessary for technological advancements. They go into chips and semiconductors, and they were pitching this to the U.S. and say, you need access and we need investment in exchange. Gabon went a step further, threw a spanner in the wheel and said, we just don't want investment. We want autonomy of our minerals. We want to be able to process them, add value, grow our economy, and create jobs for the young people. And in exchange, we want investment to develop electricity, about 8 to 10 gigawatts. But what you're getting will be that more and more young people will have less incentive to cross the Atlantic and come to the U.S., which has been a pain point for the country. President Donald Trump kept his speech very, very brief, saying that Africa has massive potential and saying he wants to build a new new friendship with Africa, but this is deeply rooted in need. They want to reduce their reliance on China, who have access and they are producers of these rare earth minerals, but then they use it for geopolitical leverage. Outside of that, very little promises made, just a slight hint that these African countries could be exempted from tariffs.
Okay, yeah, he's calling them friends of mine now. What does this visit tell us? That is it enough then to solidify U.S. as a partner in West Africa, or just a starting point?
We could say it's a starting point. It went a little bit better than they had expected, but not exactly what they had hoped for. During this meeting, we saw the emotional bids that these leaders were trying to make with Donald Trump hit a wall. The president of Senegal tried to invite President Donald Trump to come and play golf in Senegal, just 6 hours away. Trump shut it down, said 6 hours to just go and play golf is such a long journey to me. There were also remarks that were not really good for the palate, including commending the president of Liberia for speaking English, but also taking a jab at the other leaders on the table, saying they can't speak English as well as that president, ignoring the fact that some of these countries are Francophone countries and French is their national language. While they didn't have the same dress down that President Cyril Ramaphosa had, they also left with no definite goodies. And so the trip back home is going to be very interesting. And these are countries that are being courted by China, Middle East, so they are definitely going to keep their options open.
All right, some interesting sound bites there. Adira, thank you. Adira Ogange there joining us from Kigali, Rwanda with the latest. And for more stories like this from the continent, be sure to subscribe to the next Africa newsletter on the terminal and on our website. You can now also get the latest news from the continent on our weekly podcast that's available on Apple, Spotify, and wherever you get your podcasts. And we're waking up. Europe here. We'll see how things fare in the European session here today, but U.S. futures are still under a bit of pressure here, looking a little bit better in Euro stock futures here this morning. And what we're tracking, of course, is the latest trade headlines and the jitters that we're seeing in the equity space. But that's it for us here at Horizons Middle East and Africa.